Yo, so where do we start? There's so much I have seen over the last few days, people putting out data with respect to what's happening in the economy, what's happening in the markets. Silver, I'm really watching the precious metals right now just because I have some. Right? It's years. You grow up in the 70s, well, born in the 70s, 74 myself, and then grow up in the 80s, and you hear that thought process being handed down to you of having hard assets and silver and gold and all those things. Now, it's interesting how when you start looking at in recent years, they're kind of pushing people away from that in the last few decades. And now all of a sudden everybody's really, really, really hyper on that. Well, I was watching how silver hit 82, almost $83 over the weekend, then opened up on Monday at 73, that massive gap. Now, 83 is because China, they control 70% of the actual physical silver that's out there and the movement of it. They had all that happening in their market. The actual purchase of physical silver was $82, equivalent to $82 US. And then, there was data coming out. Again, this is just what I'm hearing, what I'm reading, what's being fed to me. I don't know. I'm not in these rooms. Everything I give is just what I understand. Some of it comes from experience. Some of it comes from things that I've personally done and failures that I've experienced. Ultimately, everything you do, everywhere you put your capital, anything you invest in, you need to do that in a way that keeps you safe, that you feel confident, comfortable with what you're doing, period. There's nothing I should say or do that will influence you to do anything more than research deeper and understand it and feel confident and comfortable. If you find what you discover it matches up with what we're trying to do here and the things that we're offering, then let's work together. If you're like, hey, this guy's off, then that's your choice, 100%. You are the CEO of your real estate investment business. I've been saying this for a long time. You ultimately are responsible for the decisions you make, period. I'm responsible for the decisions I make when it comes to my money. When it's gone, it's gone. I've invested in a lot of things that have vaporized. I've had people tell me one thing, outcome being completely different. It's happened. And it just happens to, I don't care how good you are. It happens to damn near everybody. I'm sure Warren Buffett's experienced things like that. The only one it doesn't happen to is Nancy frickin' Pelosi. Somehow that woman can get a 1,700% return and outperform everything. So dig into that one. Now, we had the silver situation. Now, what you have is real value being pushed up. It's becoming more and more scarce. It's put on the critical minerals list, and then it opens up on Monday where Wall Street is pushing out a bunch of sell orders, trying to force the value down, trying to control that a little bit. We'll see where that runs. It's pretty interesting to see what's happening with it. I'm pretty excited about it. I like the hard asset side of it. That's kind of the thing that I enjoy more. I've not been stocks. I could have gone into a long time ago. I saw when things were way down. I could have made a lot of money on it, but I have a hard time, and I shouldn't have the hard time as I do when it comes to putting into more of a larger company, but I've invested in smaller companies and smaller businesses and just completely got obliterated because you're investing in somebody else's ability to get things done. So think about that when you're investing with somebody on the smaller side. You really got to understand who you're working with and what their capabilities are before you put your money in there. Other thing that we've seen, the Feds back at quantitative easing, but they're focusing more on U.S. Treasuries. There's not necessarily focusing on the mortgage-backed securities, which is what drives our interest rates. That being the situation, don't get too caught up in thinking, oh, we're going to see rates drop significantly, because I don't know that that's the case. But I've listened to Richard Duncan. Let me show you his site. Check his site out. Very, very smart son bitch. Had an opportunity to interview him on a podcast as a co-host. Phenomenal conversation. This guy's great. I'm going to have an opportunity to chat with him again, I'm hoping, in the near future. But this right here opens up a lot of thought process. The Fed's creating this perpetual money machine, and it's the thing that sucks is not coming to us. It's taking our money, giving it to other people. It's their insider giving system. But look what's happening with all this quantitative easing that is going on. It's actually softening some things as far as what I can tell in the mortgage-backed securities, but it also has a peak. It has a peak value, what we've been talking about all along. So if we're looking at this here, look, we've climbed to the top of this. I've marked out long time past from right here. There's 100.52 to the 101.49. Now I might be off by a few fractions of a point here, but this represents the value of the security when they announced quantitative easing, the day they announced it back in 2008, to the end of the day's trading where it finished. This is where it opened. This is where it finished. This is where we're sitting right now. We got to the top of it and pulled right back. So there is not enough money going in on the quantitative easing side to push us up high enough to really drive the value or put people in there that feel that this is a valuable enough security to put more money into it than that. Now, our next level, if for some reason the Fed starts putting money into the bonds for quantitative easing, or announced they're going to start putting into mortgage-backed securities, this is where I believe our next level would be. This is the value of the security when the Fed actually started. So we would have capital going into that point. That would see a significant decrease in interest rates quite a bit. We're talking about another 100 basis points here. So that could be another 1% difference in cost. So that could have some pretty good influence. But what we're looking at right now, if you want to look at this from the history of it, this goes all the way back to 2008. So I can show you, this is that day's trading in 2008. This is January 2009. This was when they started quantitative easing. This is the day they announced it. This is all that day's trading. So we are still sitting in that range. And you can see every time we come to that range, we come off of it. We've held here longer. Why have we held longer? My opinion, Aaron Chapman opinion, don't take this and go invest with it and then blame me if shit goes wrong. My opinion is because we had less news coming out from the government over this window of time than we ever had in history, at least that we've been tracking here in this particular chart back to 2008. And as a result of that, we had a little bit more stability. That's just my opinion. When you don't have the government giving you data that's a lot of the time skewed, you have a little more stability. And so we've stayed fairly stable as far as rates are concerned all the way back to September. So that's where we're at right now. We'll see how things lead into it. And if for some reason people feel like they want to put more capital in mortgage-backed securities, bring those rates down, make a lower return on it, I'm not seeing it, and the charts keep showing it. I don't know how much more we're going to bounce off that top before it completely rejects all the way down to the bottom. It may or may not, may just hold stable. Hard to say. We're in a really, really weird world. Appreciate you guys. I'll talk to you on Friday.